Welcome to the daily update where I'll go over the action in the market for Thursday, November 21st, and we'll see how things look for Friday, November 22nd. November 22nd, about 61 years ago, not a very happy day in American history if you remember JFK and Dallas and all of that. Well, let's hope that Friday is a good day for everybody. We're seeing some improvement in the market right now, and it's more of the broad market that's looking better. Some of our primary indicators are looking more positive. In fact, the McClellan oscillators and summation indexes have turned positive. Our smart money indicators are looking a little bit better. We continue to be positive in the short, intermediate, and long term since we're above the moving averages. So we'll see if we can have any follow through. Now, NVIDIA reported after Wednesday, and even though it was a good report, there was sell off in after hours, and that seemed to really drag things down. It took the futures down, and the indexes like the Dow, the S&P, and the Nasdaq. NVIDIA's in all three of those indexes, so that was putting some pressure on things. And then all of a sudden, it started to come back. People started to buy the dip and bought into NVIDIA. Ended up not having a real strong day, but it helped the overall climate change over to more positive. So we ended up having a higher open. There was a lot of battling going back and forth, and then eventually we were able to break to the upside. So we're looking a little bit better there. We're not showing real solid momentum at this point with our short-term indicators, but we are improving. Okay, there's a thing called the SPX Investing Program. Please feel free to check that out. It's free until the end of 2024. And one of the benefits is you get access to these videos as soon as they are available. There's a link that will take you to the website or to a video. And if you have any questions, you are more than free to email me. The daily video is the real foundation of the analysis that I do. Now that we're finishing out the week, I'll be preparing all the weekly videos. Okay, let's go back and talk about what happened. We did have a higher open, and prices then were really choppy. It was really big. When I show you the intraday chart, you'll see what I mean. We chopped down below the unchanged level and actually went negative, and we got below the daily pivot. Again, 58.99, you could pretty much say 5,900. That seems to be a real line in the sand right now. Then we're able to get through that choppiness, and prices rose back above the daily pivot and the unchanged level. We got all the way up to R1 at 59.38. We got up to R2 at 59.60, and then we closed slightly below 59.50. So we saw a little bit of selling going into the close. We were up 0.53% on above average volume. So we're seeing an up day with volume actually picking up. As I said, we are still positive in the short, intermediate, and long term as measured by the moving averages. Interest rates, not really being all that beneficial to the market right now. And the geopolitical concerns are pretty much being ignored, both between Russia, Ukraine, and Iran and Israel. And there's been some changes about the US election and the confirmations that is taking place. And that seems to be what a lot of the news media is focusing on right now. So, some comments. NVIDIA's earnings report, it was really solid all by itself, but then there was some selling after hours, and then we rebounded up out of that. And then Google was down. This put some pressure. Large caps didn't have a really good day. Google declined on news that Chrome and possibly Android may face a forced sale. If you go back, 23, 24 years, 25 years, Microsoft went through a very similar thing. Didn't really change the company. They just kind of restructured it on paper and broke it up into different companies. And now about something that really doesn't even exist anymore, Internet Explorer. Well, Chrome has now become the most popular browser out there, and can't have that. Can't have companies having success. We've got to go in and, break this thing up somehow. So that may put some pressure on Google's stock or Alphabet. Large caps and growth did underperform. It wasn't a really good day for growth it wasn't bad for the large caps, but it really didn't show much of an improvement there. We do have a non-confirmed Hindenburg omen. This was generated after the 20th, so there's a 1-day lag on this. Be careful with the perma bears. They see one of these and they just throw up all their bearish flags. They don't necessarily, at least the ones that I follow, don't really pay attention to the confirmation process. They just say, whoop, here it is. Everything's going to fall apart. Of course, everything's always going to fall apart to the perma bears, but I'll show you that chart later on. And if you're not familiar with that, I have a bit of a description of what the Hindenburg omen is. In the intermediate term, the only thing that's really looking extreme is the Sean trend meter. And that is turning up, but it's not really extreme right now. We don't have any short-term indicators that we follow. They're improving and they're crossing above their midpoint, as I'll show you, but they're not getting extreme right now. But we are getting a little bit extreme with the 150 and 200 period simple moving averages. This is long-term. Now, as I always say, this could be a little bit of a concern, but not based on what's been happening in 2024. It really shows longer-term momentum to the upside. No real change to the scenario. There's still some doubts that the Fed's going to be able to cut rates again at their December meeting because economic reports are coming in pretty strong. The dollar was up and interest rates were up. We're at 4.43% with the 10-year yield where we had been at 4.41%. We're still inverted with the 10 to the 3-month. We get close and then we kind of back down a little bit. I'll show those charts over the weekend in the deep dive video where we are still uninverted or back to being normal with the 10 to the 2-year. Sentiment really picked up. We're still in that neutral area, but we're at 58 where we had been at 51. So that's showing some improvement along the way there. And we're still not trending as far as the ADX. We're below 20, but we're positive. The green line is above the red line. And with the update, the bias is positive and the momentum, I'm still keeping it mixed for right now. You could say mixed to positive because we are seeing some signs of improvement. But in yesterday's video, we were seeing more signs of weakness. So depending on what happens, there's a tilt one way or the other. And that's why I'm coming to more of a mixed conclusion right now. So the economic reports that came out, this was probably the biggest day of the week for reports. Weekly initial claims. These are still showing that folks are not filing for initial jobless claims. They're falling. 213,000. They expected 221,000, and it's down from the 219,000 that we saw last week. But there is a concern here. Those people that do become unemployed are staying unemployed longer, with the continuing claims going up to 1.908 million from 1.872 million. And I'll have a couple of charts to show you here. Philadelphia Fed Index. They thought it was going to come in up 7. It came in down 5.5. Last time it was up 10.3. Existing home sales, stronger than expected. 3.96 million. They expected 3.9 million and up from the 3.83 million that was seen last time there. And the leading economic index, it was down 0.4%. They expected it to be down 0.3%. So weaker than expected. Last time it was down 0.3%. So here is the chart of the weekly jobless claims where we're really trailing off and the moving average is going down. That suggests employment, the situation is staying pretty strong right now. But when you look at the continuing claims, they're continuing to go up, not only with the raw number that we get, but the moving average is back to advancing as well. And this just kind of puts it all together where we have the red line, which are initial claims, the blue line are continuing claims, and then the unemployment report that we saw at the beginning of the month with the employment situation report. And the Philadelphia Fed manufacturing, it was up last time. Now it ended up being down. And this is the LEI, the leading economic index or indicator, where it's declining here, and it's continuing to do so. And that's the light blue line that you see here. And this is the coincident. These are more things that are happening at the current time. That's continuing to go up. So looking at this, it says the LEI stopped signaling an impending recession in October. Well, we're coming right back up to this red line. I mean, we've been dancing around this. And the reason why we watch this is other times when we drop below the red line, that usually leads to a recession. And a lot of the pro-recession camp has really been pointing this out. Well, of course, that happened during COVID. All kinds of crazy things happened then. But to this point, we did drop below the red line, but no recession has really come about. And now we're coming back up to this red line and we're kind of hanging out right around at that level. Then Isabel Net, this is looking at the composite indexes for the consumer now. And that's the confidence in here. And it's kind of chopping sideways, but it is improving a little bit. And that tends to be more positive for the market, which is the black line, the S&P here. And then the truck tonnage index, we've been seeing a disconnect between these two going back pretty much since the COVID lockdowns, where the S&P's been going up, that's the purple line, or we've been going sideways with the truck tonnage index. They tend to move more hand in hand with each other, but it's not the way they've been behaving over the last few years. Then the gap between the Magnificent Seven and the rest of the stocks that are in the S&P 500, it's not 493 because there's 503 stocks that make up the S&P 500, and it's expected to narrow. And this could be more positive for the broader market, where for a long time, it was just the big companies that were really driving the indexes higher. If we see the earnings growing in the rest of the companies, that could even things out and not just have it controlled by a few stocks. Then positions in U.S. equity futures by asset managers getting pretty strong up here at a pretty high level. It did back down as we've been under some pressure, according to this chart, but this is still a pretty high reading. The economic surprise, this is where I say that the economic reports that have been coming out have been stronger than expected. And that's what we've been seeing here. And that's throwing into doubt this idea that the Fed could continue to cut rates. Now, if we see this continue to fall, that would be more in line with the Fed continuing to cut rates. Because if we keep going up, that's showing economic strength, and the Fed may have to stop cutting rates. And if this really keeps going up, they may have to come in and actually raise rates. So that's why we keep an eye on this one. Equity flows, of course, we see most of the money going into the US as it's going into other countries. We're seeing money coming out of Europe. Europe's not doing so good these days, especially when you compare it to the US market. It's really been underperforming. And I will go over that in the weekly video. And then the portion of companies beating earning estimates, of course, they like to lowball this. There is some manipulation that goes on here because then if you say, well, our earnings aren't going to be that good and looking forward, it's not going to look that great. And then they come out with this stellar earnings report. A lot of times that will really pump up the price and they get a nice little bump out of that. And so this just means that they beat their estimates. Then Yardani had a couple of charts here. This is showing the LEI, which is, I have to move this a little bit. The S&P is the red dash line here, and that's, of course, been doing quite well. And then the blue line is the LEI, and that's continuing to come down. And that's a little bit of a concern, but based on that previous chart, we're right back at that recession warning level. And then the coincident indicators, these are things that are happening more right now. That's green, and that's continuing to go up. And so, and we've been seeing that all along. And then another one here, Citigroup Economic Surprise Index, also kind of goes in line with the previous chart that I showed here, where we have the blue area, that's the Economic Surprise Index. And you can see there's a pretty strong correlation between that and the 2-year Treasury yield. Well, if we start coming back down and showing a little bit of weakness here, maybe we'll see a little bit of reprieve with interest rates going up. But if we keep going up, then interest rates will probably go up as well. Okay, didn't really spend any time on Twitter here. It's just a lot about the confirmation process and things like that. But here is the open, and it was really choppy. We opened higher, but then immediately saw some selling coming in, and we chopped up and down. We went positive, we went negative. We actually broke below the daily pivot, but we're quickly able to come back We got back above the daily pivot, the unchanged level. We made it up to R1, which acted as overhead resistance there for a while. And then we broke through and went up to R2, actually went a little bit above that before falling back down and closed right around the 59.50 level, a little bit below that. And this kind of light blue area here, this is what happened where we immediately went down after Nvidia reported their earnings. And then we just started to see a bit of a clawback with the futures until we finally opened. Then we saw the choppiness that went on in the cash session, and we're down just a little bit in the initial overnight session here. This is something that a little bit of a concern. We've been hanging on to this with the blue line above the red line. Now we're seeing the red line above the blue line. That means value is outperforming growth intraday. And not much of an improvement here with the growth to value ratio for the S&P. So we want growth to do better. We'll see if that's able to kick into gear and see the large caps and the mega caps show some improvement. That would really help the market turn back more positive. If they continue to lag, that could really drag down the indexes. So end of day, growth was barely up, where value was up over 1%. And for the mid caps, up, but up less for growth and up a little bit more with the small caps. So our end of day charts actually came down a little bit with the growth to value ratio for the small caps, up a little bit and showing some improvement with the mid caps and hanging in there, a little bit of improvement, kind of chopping sideways, but still in an uptrend when we look at S&P growth to value. This is the one that we really focus on. We want this to at least maintain where it's at, if not start to break higher. That would be more positive. If this starts to come down, that will be more negative. And we came down a little bit with our growth versus value ETF here, coming into the top end of the rainbow. So it didn't really show an awful lot of strength and still holding up fairly well with discretionary to staples. We want this to do better. That's more like a proxy growth area as well. And that will help the market to do better if this continues to improve. Large cap growth doing okay, but not up very much. We were up 0.18%, but we're still hanging in there and looking pretty solid as measured by the moving averages. As far as our trend, we're still below 20. And that's why we're in a non-trending environment. The green line's going up, the red line's going down. So we are positive in that aspect. If we could continue to go up with the green line, that'll eventually turn the ADX back up. And we're also not trending in the short term. So we have a short and intermediate term non-trending environment, but it is still defaulting to positive. And actually coming up a little bit above average with volume. That's a little bit more encouraging after it had been dropping off. Came down just a little bit here with the VIX on the line chart and the bar chart. And the VIX of the VIX also declined slightly. Not very much, though. And we're starting to turn back up here. Now, the momentum for the VIX had been down. And we're looking a little bit more positive, but now the momentum for the VIX could be shifting and going back up, which is a little bit more of a concern. And we kind of go into this seasonal time here where overall we tend to see a decrease in the VIX, which means stocks are going up. Now the skew index is back here again. So we're up into this red area. This is a variation of the VIX where the VIX uses at the money options for how it's calculated. The skew index uses out of the money options. And since we're up into this red area, the market is expecting some kind of a big move. Is that going to be to the up or the downside? We're not really sure based on this chart. And we went up a little bit with this fair gauge where we're going down with this other fair gauge. So we're seeing some contradiction. And we did get the latest reading from American Association of Individual Investors. They really dropped off because a week ago, things were not looking all that great. And that was freaking out some individual investors. The equity put call ratio daily chart did decline. So now we're just seeing a flip-flop here. The 5 days going down where it had been going up, and the 10 days going up where it had been going down. So we're not seeing a lot of confirmation there in the shorter and a little bit longer term. Coming up a little bit, but just to the lower end of this range with the volatility risk premium. That's picking up just a little bit there. Did see some improvement with the advanced decline line based on price and volume, not breaking out to a new high yet, but we're not at a new high with the S&P. So this really showed some improvement. And we saw a real couple of days now of an expansion of the new highs. So our 5 days finally waking up and trying to at least stop going down. We're starting to go back up with the 10-day, and we didn't really see any new lows that were expanding here in Thursday's session. So this is also showing internally in the S&P, we've had a couple of good days of new highs now, not necessarily the large caps or the mega caps. And so that's more positive for the market or for the index as a whole. After we were looking a little more negative here, we've dropped back into positive territory with the 19 and 39-day advanced decline ratio. We're above the moving average and going up with accumulation distribution. So this is now positive. Still negative here, but showing some improvement with the chicken money flow. The red line is starting to go back up, and we've been seeing a gradual improvement of the histogram. That's the red bars that you see going down. And we're positive here with the chicken oscillator. So we're seeing some gradual improvement where we were looking more negative yesterday. Now we're switching back and looking more positive. The vortex is showing some improvement with the green line going up and the red line going down. A little bit of an improvement with the S&P cumulative advanced decline line based on price, but not breaking out to a new high. Also showing some improvement based on volume, and not really seeing much of a disconnect here when we compare the S&P to the NYSE advanced decline line. Nice little improvement here with the cumulative advanced decline line for the NYSE coming right back up to the moving average with the regular NYSE advanced decline line. Also coming back up to the moving average with this other NYSE advanced decline line. So a bit of an improvement here with the common stock based on price and volume with the NYSE. And our advanced decline line showing some more improvement here, crossing back above the moving average with the NYSE common stock, still bouncing up off of the moving average with the S&P, coming back above the moving average with the mid caps and the small caps. So there was more across the market strength in Thursday's session. This is still negative, but this is longer term. This is a 5-day moving average of the highs and lows across the broad market. We're improving, we're coming back up, but we are still negative with this reading. Saw an improvement here with those stocks in the S&P above their 20-period moving average, 50-day moving average, and 100-day moving average and 200-day moving average. So that's showing across the board improvement there. In the short term, it's really hard to see with this big P here. We may have hit some overhead resistance at this previous pivot point here. We finally fell down below it, and now we're trying to come back up to it. I know that's really hard to see, though. And we were above average with volume. So we saw an improvement with the 20, 50, and 200 period moving averages, crossing back more above the midpoint with the Stochk RSI. The Williams percent R is looking better. The CCI 14 still above the midpoint and turning back up with the CCI 20. Not extreme with the stochastics, but looking better in the short term and intermediate term. We're still declining with the longer term stochastic. The force index looking a little bit more positive, but still below the midpoint. And coming right back up to the green line and the blue line here with our short-term evaluation of the trend based on 20 periods. And we're still above the simple and exponential moving averages based on 20 periods. This held along the way. This is the short-term support we've been following. Crossing back above the midpoint and right on the border between the +1 and +2 standard deviation channels. So that's improving. We are looking a little more positive with the balance of power, and we're coming right back up to the red line and the blue line with the condition of the 50-period moving average trend here. And we're turning back positive with the go, no go. That's darker blue, crossing back above the midpoint with the highest high value chart. And this is like, it's goes negative, then positive, then negative. Now it's switching back to positive when we look at the TTM squeeze. And seeing some improvement with the ease of movement. No change with the Erin indicator, but it's still positive. Crossing back above zero with the S&P McClellan oscillator. So we're starting to turn back up based on price and volume. So we had been declining. That's negative. If we can continue to turn and go higher, that would be positive. And we're crossing barely above zero with the NYSE McClellan oscillator. You can't really see it, but we're just barely ticking up based on price and volume. And turning positive with the Swenlin trading oscillator. We crossed back above zero based on price and volume here. Momentum, that takes a little longer to work its way out. Still looking kind of negative with the PMO, turning back up but below the moving average based on price, turning up and still below the moving average based on volume. So the PMOs that are rising are improving. We're starting to tick back up with the buy signals and flattening and trying to go up a little bit here with the PMOs above zero. And kind of rolling over here with the slope. That's our short-term oscillator here. We're above the green line, which could be considered extreme positive. But if this could continue to go up and actually cross back above and get further above the moving average, that would be more positive in the short term. The MACD is still negative though, but it's at least trying to flatten out after declining. So the short term slope could be rolling over. We're actually still negative with the TSI. We're still negative with our intermediate term oscillators, flat with the tricks, and still positive with the KST, the longer term oscillators. Still positive here with the Copic curve, even though it's been rolling over. The Sean trend meter trying to go back up. It's in this green area, which is extreme, but there's two other green areas that are even more extreme. If we continue to go up, we might hit. We are positive with the money flow, and we've crossed back above 50 with the ultimate oscillator. On balance, volume is still positive, and we're above 50 with the RSI 14 and 9, so that's positive in the short and intermediate term. We've gone from neutral to positive with the Elder's Impulse system for the S&P, and we continue to be positive with the parabolic SAR since the dots are underneath. And this is one of those crazy ones. Even though we haven't been really diving as far as price, the Pring bottom fisher is starting to generate a buy signal here. Now, there's been other times when this actually ended up being a pretty good signal. The reason why I'm showing this chart is we were getting a pretty deep reading here back in April when we were really going down with more of a decline. We eventually crossed back over, and that ended up being a pretty good little buy signal there. We'll see if this downward to sideways action producing this crossover here, if that'll turn into something more positive as well. Still positive with the moving averages. And we're actually ticking back up with the bullish percent index where the context had been down. Now we could be starting to go back up and ticking back up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. Not much, but at least it's turning up. Still above the 20 period simple moving average of the open, high, low, close here. These support levels have been holding. And looking more positive with the hike in ASHI, we're pointing back up with the Kegi chart. That's turning back more positive. Positive with the Renko chart, but we're still looking negative here with the three-line break. Not enough of a move yet for that to redraw. Long term, starting to get above this red line with the 150 and 200 period moving averages. And we're positive across the board with the Keller market model. And no real change here. We're still negative with the bonds based in the short and intermediate term when we look at price. Positive with commodities in the short term, and the dollar has turned into an uptrend across all different time frames. And the only sector that ended up being down was communication. Utilities really strong lately. That tends to be more defensive. The financials were back to looking solid again. That we like that. Industrials and materials tend to be driven more by what's going on with the economy. Staples tends to be more defensive. Tech was up, but we would like it to be stronger. Healthcare was up after just getting hammered lately. And discretionary was up as well, but not by very much. And so we saw some green to kick off the day. We read this from the bottom up with the NASDAQ getting above 19,000. We did see a BPI cross above 70 with the industrial sector. Then we saw a BPI cross below 70 with communication. That's growth. Then we have the NASDAQ bouncing around between 18.9, 18.8. And then Canada seems to be partying up pretty good there, setting another new all-time high. We did have the S&P cross below 5,900, but then it got back above it here with the dollar setting not only a 52-week high, but a 2-year high. And the Dow got back above 44,000, and the utilities have a BPI cross above 70. And not really seeing much of a difference here between the weighted and equal weighted version. And that's what we've been seeing lately, as it's not just a few stocks that are really driving things now. It's more of the entire index. The Dow came right up to this R2 point to close. We broke above it, but we closed right at this pivot point, which may be acting as overhead resistance. We've gone from neutral to positive with the diamonds, and we held at this R1 pivot level here with the NASDAQ, even though it was virtually, I mean, it was up 0.03%, not much of a gain there. And we were up 0.36% with the NASDAQ 100, also still holding above this R1 pivot level. And we've gone from neutral to positive with the Qs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 is still negative. It's going to take a little while for that to shift over positive if we keep going up. Small caps were up 1.66%, breaking above this R2 pivot level, which may have been providing overhead resistance. And when we look at the Russell 2000 small caps breaking further above 50, that's positive, but the momentum is still negative, even though it's improving for the small caps. We've gone from neutral to positive with the small caps when looking at the Elder's Impulse system. Mid caps actually broke above this R2 level, and I pointed this out a couple days ago. There was earlier in the year when the mid caps actually provided support, and we came right down to this R1 level, and we've been bouncing up off of that. It's like, okay, doesn't really make a lot of sense, but it doesn't not make sense either. I mean, we've seen that before, and we could be getting some strength from the mid caps if we see more follow through. We've gone from neutral to positive with the mid caps with the Elder's Impulse system. We were up 0.68% with the Wilshire, up 0.67% with the total stock ETF. Financial sector setting another all-time high here, looking really solid that way. Down just a little bit with the FANG index. We're still below the shorter-term trend line, still above the longer-term trend line, but not seeing a lot of strength there right now. Apple, and you're going to see this when we go through the Magnificent Seven or the Great Eight or whatever number of charts we have here. We were down 0.21%, still above the 50-day moving average with Apple, and we're down 2.22% with Amazon. Microsoft was down 0.43%, still below both moving averages, but we haven't generated a death cross yet. Google got hit. That's because of the news about Android and Chrome possibly having to be sold. So it's taking a bit of a hit there. Meta was down 0.43%, still below its 50-day moving average. Nvidia, after all that fuss, ended up being up 0.53%. Tesla was down 0.7%, but Netflix just keeps screeching on higher, up 1.54%. And seeing an improvement between US and world stocks in the short term, longer term, we're still seeing that correlation deteriorate. Oil did come up, and we're into the 70 range now, but really no reaction based on what's happening geopolitically. The dollar is now getting up into the 107 range. We haven't been up here in a long time. Great if you want to do some traveling, not as great if you're into stocks or into the import-export relationships between the two. And we were up here with the 10-year yield. We were down with the 10-year based on price. And I couldn't show a lot of these charts yesterday because there was some erroneous data. But this one I did show yesterday. It's the one after this. But not really seeing much of an improvement here with the Qs to S&P. Coming down, but still looking solid with discretionary to the S&P. Dropping a little bit below the moving average when we compare large cap growth to large cap value. So the large caps dropping below the moving average, seeing some improvement here with the mid caps, and not much of a change coming down, but still looking solid with the small cap growth to value ratio. So what's our outlook for Friday? We are still positive here, and the weakness that we're seeing, it hasn't gone away. It hasn't turned into strength, but we're seeing some improvements coming in here. Now we need to see some more follow through. We're going to get the global U.S. manufacturing and services PMIs. Those are two separate reports. I just put them on one line here. And then consumer sentiment will be coming out as well. All the crazy geopolitical things to see if that has any impact on the market. And here is the finishing up of the calendar for the economic reports coming out this week. And here's what the previous readings were for this. We'll be watching the services to see if it stays above 50. That shows expansion, where below 50 shows contraction. Seasonally, we're positive across the board for November 22nd with the Dow, S&P, and NASDAQ. We're also going to be finishing up the week after options expiration, which tends to be positive as well. And then this is just coming between Thanksgiving and the Santa Claus rally, where we tend to see positive seasonality with the S&P and with the small caps. And we'll be on the 16th trading day of the month, where you can see not only for Friday, but going forward, for the most part, we do see some positive seasonality going into the end of the month. A little bit of a drop off at the end, the last trading day. And this is new. November can be weak now, then rally late. Well, we kind of been going through a bumpy period. We're starting to come up out of that. We still have one more trading day, and then the 23rd will be Saturday. So we might go into some positive seasonality as we finish out the month. And Friday is the second strongest day of the week in 2023, and it's the strongest day so far in 2024. And we're coming out of that weak time and now going back into the strong time, according to Tom Bowley's research. And here is a look at the positive seasonality based on Carson. And then after the election tends to be positive. And in 2020, the seasonality was also positive then. So now we had a pretty long list of warning signs. That list is getting pretty short, and we're looking a little bit better with the positive signs. It's going to take some time for the oscillators. The Copic curve, it's positive, but it has been weakening. And the oscillators are still looking more negative, but they could improve, but we have to see follow through there. The 10-period equity put call ratio is going up. That's longer term negative. And the momentum for the NASDAQ 100 is still negative. And we do have a non-confirmed Hindenburg omen. I'll go through that here in just a moment again. Our smart money indicators are looking better, with accumulation distribution being above the moving average. Chaikin money flow still negative, but the red line's starting to come up, and the Chaikin oscillator is actually positive. And the S&P and NYSE McClellan oscillators have turned back. They've crossed back above zero, so that's turning the summation indexes back up. The Swenlin trailing oscillator also going from negative back over to positive. The vortex is positive. The 5-day equity put call ratio is going down, which is more positive. The growth of value for the large caps holding up, but not really showing any bust out strength right now. And the same thing with discretionary to staples. Came down a little bit, but still holding up. The advanced decline lines are showing some improvement pretty much across the entire market. And our moving average studies are also showing some improvement. And they always were positive. They were just showing some weakness. Now they're showing some more strength. The parabolic SAR is positive, as are the bullish percent indexes for the S&P, NASDAQ, and NYSE, where they had been declining. Now, at least in Thursday's session, they started to tick back up. The ease of movement and the money flow are positive, as well as the ultimate oscillator and the financial sector, setting an all-time high there. Hindenburg Omen, if you're not familiar with this, feel free to pause this and kind of read through all this gobbledygook. This kind of explains the theory behind it. And then stockcharts.com takes all the criteria, 1, 2, and 3 that you read about here, and puts it into one chart. So you don't have to calculate it yourself. And we did have one last September, and it was confirmed, but it didn't really lead to anything, and it didn't lead to any more of confirmations. And then after 30 days, that it drops off. Well, we have the initial signal here. And so now what we're going to be watching for is between now and December 19th. That's 20 trading days. Are we going to get another spike? That's when it becomes confirmed. Until then, it's just a lonely spike here, but we'll just be watching it. But if December 19th comes and goes and there's no other spike here, then this will fall away as well. So our conclusion, we are positive, but we're not trending in the short or intermediate term, but we are seeing signs of improvement. And so we are improving in the short term, since we're well above the 20-period moving average. And I didn't know how to word this. Weakness decreasing. It's not really strength. It's just that the weakness is going away a little bit in the intermediate term. But we continue to be positive in the long term. We're getting above that line that I draw on the chart there for the 150 and 200-day moving averages. Thank you. I hope you have a really good day, and I will talk to you in the next video.